Hey, thanks a lot, Marty. I really appreciate the opportunity to talk to this group. I think this is my 12th time, so it's been a dozen times I've presented to this group, and it's been a real pleasure. Just by way of background, I spent about 35 years on Wall Street. 25 of those years were on the sell side, predominantly in technical analysis and global macro analysis across the equity capital markets side of the firms that I've worked at. Spent the last 10 years on the buy side, one running a global macro hedge fund where I predominantly ran the short book. So you're going to see a bit of a bearish bias here. I guess it's in my DNA. But I've always been a skeptic, and that's been one of the things that's kept me honest in this career. About 5, 6 years ago, we launched an institutional research product called Alpha Insights, primarily helping other hedge funds, global macro, long short equity is our area of focus. About 4 years ago, we launched a follow-on newsletter on Substack. It's become quite popular. It's called Huge Insights, the Big Picture, where we talk about a lot of global macro factors driving markets. And we've actually launched a tactical asset allocation portfolio about a year and a half ago. It's doing quite well, up 17.7% through the end of August, beating the S&P by about 700 basis points. So, nice little sidecar business for us as well. We predominantly are a family office. So like you, we're very interested in managing our own book of assets to optimize our performance around opportunities that exist across a variety of alternate areas. One alternate area that we've been very big in is metals and mining. And gold was our trade for the decade. We announced that a couple of years back, 3 years ago, and that's panned out very well for us for 2025. We came out with our top actionable trade for 2025 was silver. It's actually beating gold, and we'll talk about that all a little bit later. But to begin, I'd really like to just kind of introduce you to the way we kind of look at the world and the economy at large, and we do it through the prism of our economic cycle model. And this model really is about roughly 115 years of detrended quarterly price data that we took from the Dow Jones Transportation Average. Why the Dow Transportation Average? Well, it's the most cyclical price series with the longest history. And we did a lot of testing on various series of data, and this was the one that really created the closest synchronization to past economic cycles. And so we could see a very clear sine wave that goes through this price data when it's detrended. And basically what we've determined is that the cycle probably topped around the middle of 2022. And we're now in the down phase of this cycle. The cycle is about 34 years from trough to trough. So we're kind of in that 18-year-ish sort of downtrend cycle. That doesn't mean that the market's going to crash or the economy is going to crash or we're going into a depression, although we wouldn't rule any of those things out at this point. But what it means is that rather than having the wind in your sail, the wind is in your face at this point. So it's going to be more difficult to generate real GDP growth in this phase of the cycle. And we expect this phase to continue until about the year 2039. So we're very early in this process. And, we could see, some kickback rallies in the economy in general, driven by AI and some of the other sort of, new evolutionary technologies that are coming in energy and things of that nature. But for the best, in the grand scheme of things, I think we need to think of it as though the wind is in our face and prepare and allocate accordingly. So with that said, let's take a look at some of the drivers. We'll look at both fiscal and monetary policy. Our view of fiscal policy is that Washington's in utter turmoil right now. I think the impact of Doge, and I know things are still ongoing. It's not getting as much publicity as when Elon Musk was heading it, but at the end of the day, the government has a goal, and the goal is to basically reduce headcount by 10% and reduce government spending by 10%. And if they do that, okay, if they do that, we expect about a 2.5% reduction to nominal GDP on an annual basis. Why? Well, the government's the largest employer in the world. So if we cut 10% of the jobs, well, they employ 10 million people in terms of civilians and contractors. That doesn't even include military. That's another million if you throw that into the mix. Well, 10% is a million jobs. So if we eliminate a million jobs, that's likely going to boost the unemployment rate to around 4.7%. The government also spends about, roughly 25% of US GDP, or $7.5 trillion annually. And so if we cut that back by, say, $750 billion, that's a 10% reduction, that's going to trim about 2.5% off annual GDP. The other thing that we're concerned about right now is the impact of tariffs. Now, assuming that Trump's tariffs are deemed to be legal and that those tariffs remain in force, and that they average, say, around 10%. That's about half what they're currently averaging. Now, we peg them somewhere around 18.8% right now across the board. So, if they were to kind of just come in around 10% when the dust settles, all is said and done, that equates to about 1% reduction in annual nominal GDP. So we're talking about a 3.5% nominal GDP hit based on all of the impact of all of these fiscal efforts right now. So if you were to take 3.5% GDP reduction, what's that going to do to the fiscal deficit? Well, it's going to widen it significantly, right? And there are going to be significant revenue shortfalls and higher spending. And so, you're going to increase the debt burden relative to economic output. And all of these things basically put us in a worse position than we would be. You think of it this way. If we cut government spending, it's basically withdrawing fiscal stimulus. And fiscal stimulus, well, the economy's addicted to it. It can't live without it. And as a result, I think it's going to have a negative impact. The next thing we want to really focus on is monetary policy, which is really getting a lot of headline interest from the press these days. Obviously, President Trump has been berating the Fed chairman for being too late to cut interest rates. And in fact, he might be right. It looks like the consensus view based on Fed fund futures has about a 90% probability that we're going to see a rate cut of 25 basis points on September 17th when the FOMC makes their interest rate decision. I think that's going to happen. But the Fed fund futures are also pricing in about a 70 to 75% probability that we get 2 more rate cuts before the end of the year. Well, that would bring us down to about 350, 375 on the Fed funds rate. Based on what we're seeing across the board in leading data, it probably makes sense that the Fed does begin to cut. But the problem is the Fed has a dual mandate, right? And the dual mandate is both employment and inflation. And one of the problems that we are able to discern from the tariff implementation is that we're starting to see a lot of increases in producer prices, right? I think consumer prices have come down dramatically from the peaks that we saw in 2022, roughly 9% on the CPI. We've gotten down to the mid 2% range, but now it's ticking back up. The latest CPI came in considerably higher, and PPI actually came in around 3.7%. So, what we're faced with right now is this kind of bifurcated situation where we're balancing the risks of economic deterioration and employment with the risks of rising prices, both at the producer and consumer side. And so, I think the Fed's kind of painted themselves into a corner here. The administration has a strong desire to see the short-term rates come down. President Trump said he'd like to see them down about 1%. I think more realistically, 3%, looking out a couple of years by the end of 2026 seems reasonable. And that assumes that we do have a continued decline in economic activity, which it looks like we're going to get. In fact, if we take a look at the two-year Treasury yield, which is pretty predictive of where Fed funds rates are headed, with about roughly a 9 to 12 month lag. It looks like 3.5 is a pretty good bet at this point. And if the 2-year continues to trail down toward 3, then we could see that 3% Fed funds rate come to fruition by the end of 2026. The problem with this is in every other big cutting cycle, like we saw back from 2000 to 2002, it attended a major recession and a major bear market in equities. Same thing we saw from 2008 down to 2010. And then, of course, during COVID. And most recently, we've seen a 21% sell-off in equities as the 2-year Treasury yield is predicting the Fed's rate cutting cycle, which actually began about a year ago. Recall that they cut 100 basis points off the Fed funds rate in the fourth quarter of 2024. So this rate cutting cycle is actually in progress already. It's just been on hold recently. And so, I think investors need to be cognizant of the fact that just because the market has rallied here to new all-time highs, that does not necessarily mean we're out of the woods. It actually means we're starting this potentially problematic period from a very difficult level. A very highly valued level, almost 39 times on the Shiller-Cape ratio, the second highest Shiller-Cape ratio in history. So our concern right now is that inflation is going to creep back into the picture, making it more difficult for the Fed to continue to push rates lower and prop up through monetary easing economic activity and generate liquidity in the system. And so, again, we've seen, the core PPI come in as recently for July at plus 3.7%. It tends to lead the CPI by about roughly 60 to 90 days. So that increase in producer prices is likely to flow through into consumer prices over the next 2 to 3 months. And we already saw that the core PCE, which was reported a week ago or so, came in up plus 2.9%. So there's a pretty good bet that when the CPI data is reported this week, we'll see another uptick. So, Torsten Slok of Apollo puts out some pretty interesting charts, and he did a nice overlay of the current scenario or the current inflation picture, basically from around 2014 to present. That's this blue line right here, or I'm sorry, the green line rather, which ends right here. And he overlaid that with the 1974 to 1982 scenario, which is the blue line. And it actually, syncs up pretty closely with the most recent spike in inflation and pullback. And now, the next question is, are we setting up for another acceleration in inflation? Is this going to basically play out the exact same script that we saw in 74 to 82? It remains to be seen, but the setup looks possible at this point. So I think we need to be cognizant of this potential, right? What's the bond market saying about it? Well, it looks to us like bond market vigilantes have come back in style. What we have here is a 5-year chart, and this is a monthly chart of the 10-year Treasury yield, which bottomed way back in 2020, down at sub 0.5%, right? And since that time, we've seen this big advance up to around 5% in 2023 and a retest last year, or actually earlier this year, around February or so. And so, the question here is this range going to break to the upside or to the downside? We've traced out what looks to be a triangle sort of formation. And triangles tend to resolve in the direction of the prevailing trend, which was from very, very low levels to recent highs. And so this uptrend is the likely outcome, a resurgence of higher yields. Now, what we've done here is we've overlaid an Elliott wave analysis, and this is our interpretation. And if we're correct about this, we've seen, a primary degree of trend, waves 1, 2, and 3 trace out, and three subdivided in five waves as well, which is typical. And then wave four is tracing out a lateral consolidation of a symmetrical triangle. It's an A, B, C, D, E pattern, another typical Elliott wave pattern. And it appears to be bottoming right now around the 40-month moving average, which comes into play right here. And so that 40-month moving average will likely hold. And unless it doesn't, I think that the path for rates going forward will be to the upside. Now, what could be a catalyst for that? Well, what we saw last time, a year ago, when the Fed began aggressively cutting rates, 50 basis points followed by 225s, is the long bond actually backed up 100 basis points. We were trading around 340. It rallied up to we're trading around 360, and rallied up to around almost 5% in late January, early February. And so, that sort of bear steepener, that dreaded bear steepener, where the long end of the curve moves up as the short end of the curve moves down, is a possibility that I think remains out there as a potential catalyst for problems, right? And so if we do see this occur, what might be the cause of that? Well, we're seeing a bit of a breakdown here in the dollar. The dollar has kind of traded in this range for some time. It broke down below what I would call chart support. It's now it's now testing this trend line support. It's rallied off this trend a little bit, but come back to test it. It's now looking at its 10-year moving average and trading below it. And so I think, if we think about what's happening in the dollar and what's happening to rates, if rates were to start backing up on the long end, I think that would be consistent with the decline in the dollar. And it's a chicken and the egg thing. Maybe the dollar's anticipating that and the dollar breaks down, and that's the reason rates back up. Whatever the reason, the relationship has occurred in the past, and it seems possible that it could occur in the future. One of the things that gives us confidence that we'll likely see a breakdown in the dollar is the structural momentum has already broken its uptrend, and it is dancing along kind of what has been a line that's bifurcated past highs and past lows. And I think a breakdown of this would be consistent with a pretty significant technical breakdown in the US dollar, which could carry it down some 7 to 10 percentage points from where it currently trades. There's a lot of implications for that. But one of those implications is we should see a re-steepening of this yield curve, a significant re-steepening. And we're already 55, 60 basis points in the black on this re-steepening. And a lot of people talk about, inverted yield curves and how an inverted yield curve predicts a recession. Well, that's not actually true. Inverted yield curves tend to precede recessions. It's actually when the re-steepening phase begins that the recession is more of a concomitant attendant process, right? Historically, we've seen economic recessions ensue with that re-steepening phase, and it's basically the Fed reacting to bad economic data. They're trying to stimulate borrowing and spending in an attempt to stave off the recession. They're usually too late. They're probably too late this time. And what tends to happen is we see a pretty significant re-steepening phase, usually upwards of around, say, 200 to 300 basis points of total re-steepening from that preceding inversion. And so we've got a long way to go is the bottom line, and that could coincide with the recessionary condition. Another leading indicator of recession is the quits rate on the construction data. So, we just got the Bureau of Labor Statistics data for, the month of August, and we actually previously saw the BLS job openings, the JOLTS report for July. It came in with about 7.2 million jobs available. That's a big decline from previous levels, upwards of 10 million. And so that's got some people kind of, scratching their head. Fewer jobs available. Maybe this has something to do with AI. Maybe it's, a precursor to an economic recession. We think Both of those things are partially true. But one of the things that we're seeing right now is a big decline in the number of quits in the construction industry. Now, construction industry is one of the most cyclically oriented industries in the U.S. economy. It's also one of the largest employment industries in the U.S. economy. And typically what we see is high quits rates when things are going great. And the reason for that is construction workers are finding better opportunities with higher pay. It means that there's so many projects that project managers can't find enough skilled laborers, and those with skills are very mobile. And so they quit their current job, take another job, doing the exact same thing for a higher price. Well, that has collapsed to the lowest level since the great financial crisis. And so what's the reason for that? Well, it's typically a sign that construction projects are slowing down, that there's very, very low hiring, and that skilled labor is no longer in demand as it was before. It's a typically precursor to an economic slowdown, and almost always occurs ahead of a recession. We saw it occur back in the early post tech wreck recession. We saw it during the great financial crisis. We saw it again here during the pandemic. We have not seen the ECRB report a recession yet, but that's usually done 7 to 10 months after the fact. So we would fully expect to see a gray bar show up right around here, in the next year after these data are fully reported. Something else that has us concerned is loan delinquencies. They've spiked up to near GFC levels. I'm specifically concerned with auto loans right here. Auto loans topped at exactly 5%. Your delinquency rates on auto loans topped at 5% during the great financial crisis. We're at 4.99% now. This is data reported just through the second quarter by the New York Federal Reserve. In the month of August, they published that report. The other thing we're seeing that's noteworthy is that credit card delinquencies are just less than 1%. They topped at 13% in the GFC. We're at 12.25% now in delinquencies. And then student loans. Student loans are just getting started. We've seen a huge spike, 10%. That's because they weren't reported for a long time. For literally, I think 10 quarters consecutively, it did not report the student loan data. That is now being reported, and we're seeing, considerable delinquencies beyond 90 days. And so, these three factors right here, which account for, basically, $8 trillion in total debt out of 18 trillion. The other 10 trillion is mortgage related. This is very, very concerning, and will crimp consumer spending considerably. In fact, those who can't make their student loan payments are seeing their credit scores, slammed from 750 down to 600. They can't even take out a new loan. So that is going to slow consumer spending dramatically. And the U.S. economy, as you know, is 70% consumer related. So the question is,
hey, Jeff, just a quick on that last slide. I think I read this morning that something like 10% of CMBS is in default right now. Any real estate guys here?
That is correct. And a lot of it
2 months
in the big cities where you'd expect it, San Francisco, LA, a lot in New York as well, although I know New York is experiencing a bit of a comeback right now as well. So, Marty, as I'm saying, basically all of this data points to an increasing probability that the U.S. economy is poised for a recession. If we were to go into recession, what is the consequence of that? Well, we looked at the past 10 recessions from 1957 through April of 2020, and the average drawdown in earnings during recessions is about just a little under 30%. If we kick out the two worst, the great financial crisis and the tech wreck, it's more like 19%. But for all practical purposes, I think this one could be worse because the bubble's bigger than any other bubble we've ever experienced. In fact, it's an everything bubble. It's not just a stock market bubble. It's a bond market bubble. It's a real estate bubble. And all these bubbles are basically poised to be pricked by the same pin. And that pin is going to be this cut back in fiscal spending and the implications of tariffs on consumer prices, and that basically inability of people to get jobs and pay their bills. All these things are conspiring together to put pressure on the economy, and I think earnings expectations have never been higher than they are today. Actually, forward 12-month earnings estimates for the S&P 500 are $280 right now. I think I'm pretty skeptical about that number. I think it's more likely that we're going to see that number come in sub 250. But let's say we got a 30% drawdown over a number of quarters. Let's say it's a 4-quarter drawdown. Over the next 12 months, we could see earnings come in closer to $187 in a worst case scenario. So, somewhere between that sub 250 to around $187 is likely where earnings are going to be. And what does that mean? Well, if the odds are shifting toward a recession, and we think they are, then valuations are really going to start to matter. And valuations have never, ever in the history of financial markets been higher than they are today. We presented at these conferences and many, many others, numerous data sets illustrating, how overvalued the S&P 500 index is based on price to book, based on price to sales, based on PE of forward and trailing earnings, the CAPE ratio, market cap to GDP, all these things. Well, what we've seen here is, we've actually taken all of these measures together, and we've looked at them on a percentile basis going back to, basically the turn of the last century from 1900 to present. And what we've seen is that the combination or the aggregation of all of these valuation tools has now reached a new all-time record high as of August 25th. It exceeds the roaring 20s bubble peak of 1929, the post-World War II industrial peak of 1965, and the tech bubble peak of 1999. So this AI bubble is absolutely the greatest extreme we've seen in stock market valuations based on the S&P 500. Now, a lot of people would say, well, okay, the market's very concentrated. All of this valuation excess exists in the AI trade. Well, that's true, but the AI trade is 35% of the S&P 500 and 45% of the NASDAQ 100. And the problem that we see right now is that adoption of AI is rolling over. A report was just published on Monday by Apollo, basically showing how AI's concentration and the fall off in demand for AI is setting up for one of the biggest financial accidents in history. And so, I think the pendulum likely will swing in the opposite direction. And the problem is they tend to overshoot by an equal amount when it swings in the opposite direction as well. And so I think this is a dangerous place for investors to be overweight equities and especially overweight technology. And
hey, Jeff, we have about 5 minutes, and then I want to do some intensive Q&A with you.
Sure. Then I'm going to tell you.
Just give you a lay of the land.
I'm going to give you where we've been and what's working. So this is the equity index scorecard right now, year to date. The interesting thing that I see here is that equities aren't really participating. I mean, the Dow's up, or I should say the S&P's up 11%. It's, an average year, right? Growth stocks, the NASDAQ 100 up a little bit better, up 12 and change. But what's really working is silver and gold, okay? These monetary commodities. And what's driving that is central bank purchases, in anticipation of lower interest rates. And basically, investors are positioning for a potential financial calamity. And this is a great insurance policy. What's also interesting to us is that foreign equities have doubled the performance of the S&P 500 year to date. So it really points to the fact that non-dollar assets are outperforming dollar-denominated assets. Now, we've looked at the S&P 500 from a structural perspective, and from our lens, we see the S&P, dancing toward this upper boundary of a long-term trend channel that's been in place back since the 1930s. And if we see that pendulum swing in the opposite direction from valuations, I think that we could see a retest of this 34-year simple moving average and retest these, support levels back down here in kind of the mid 15, 16, 17, 1800 range. If things got really, really bad, we could test the lower boundary of the trend channel. I'm not shooting for that, but it's something that could happen and something that you can't dismiss. If we just look at this leg right here and just magnify that and get a sense of where we are, our look is that we're putting in a kind of a textbook ending diagonal pattern. We've got this Elliott wave form. It's a 1, 2, 3, 4, and this fifth wave up comes in this, ending diagonal where the upper and lower boundary are kind of a converging, pattern. These two boundaries converge upon one another, and that's typical when things are coming to a head. If we blow up just this, ending diagonal pattern and take a look at where we are in that, again, it's very textbook in it, and we're completing it. We've put in all the waves necessary, give or take, maybe one final, push to a slightly modest new high. So let's blow up this last little leg here and take a look. By the way, take a look at how momentum has made lower highs with each progressive high in the S&P 500. That is indicative of a trend that is ending, that is losing steam, that is coming to its terminal point. Okay, so looking at this final move off this April 7th, April 8th low, we see a parabolic arc that's coming to a head, and actually Friday's peak intraday high of 65.32 on the S&P 500 hit that arc perfectly. And so I see this as, the very, very last echelon. Maybe it can push up one more time and test it again. I don't know. Nobody knows for sure. But, I think if we break down below this 50-day moving average at 63.26, all bets are off. And I think you've got to take into consideration the serious possibility that we could get a many thousand-point decline in the S&P 500 back down to at least 4150 initially, and potentially as low as 3,000 before the real selling stops. So what are we doing to kind of protect ourselves against that? Well, we think using portfolio overweights of gold bullion on the one hand and short-term treasuries on the other is a great insurance policy. It's a simple barbell strategy that provides hard assets hedge against inflation and currency devaluation, as well as liquidity hedge against deflation and recession, all while providing an uncorrelated alternative to the traditional 60-40 bond allocation. So, we're basically adding this as kind of our alternative strategy, inserting it in there. And, it's up to every asset allocator to determine how much that they want to allocate toward this. But we think a good 25% should be in this barbell strategy to add more ballast to everybody's portfolio. What's our target on gold? Bottom line, we think gold can go a lot higher. Our near-term target is 38.50 before year end. Our 12-month target is 46.50, and our long-term target is 82.50. We think we'll get there by the end of the decade. So with that said, let's get into some Q&A, and obviously you can reach out to me separately via my website, via Twitter, or you can check out my newsletter on Substack. It's hugeinsights.substack.com.
Hey, Jeff, you're going to send a copy of this presentation to me, right? So I can
absolutely
distribute it to the group online?
Yep.
Fantastic. So before I ask any questions here in the audience about the outlook? Andy. Hold on a second. Annabelle, can you come on over here and get Andy a mic? Andy needs a microphone because he's got a question that's longer than 5 words. But he can't hear you. You can't reach all the way to him. Where are you, Jeff? South Dakota? Iowa? Idaho?
Minnesota.
Hey, Jeff, how do you get to 38.50 on gold?
It's a technical target. I would look at that.
Is your mic turned on?
I would look at that triangle, and that triangle counts up to around 37.45. we had a Fibonacci
Oh,
extension to
Buttons
that. We
green.
also have
Oh, now you're good. Okay, we got a question
Okay.
from the audience.
Elise is the tech support here. Okay. So you were talking about, the Fed, maybe lowering rates, whatever, but you were talking about the economy softening. I'll make it loaded and say some people think the Fed is always too late reacting to whatever, okay, whether it's inflation or whatever. So if things are getting soft, do you think they will react more quickly or too slowly to a slowing economy?
So
Yeah.
Jeff, did you hear the question from Andy?
I did, yeah.
I just want to just append to that a famous quote from Ed Yardeni, which is "Don't fight the Fed." So, what are your thoughts?
Well, so the Fed was aggressively easing throughout the dot-com wreck. They cut interest rates by 250 basis points. It didn't do anything to stop that. They cut rates down to zero during the great financial crisis. It took, a near $1 trillion bailout from the federal government to put an end to that. The Fed is impotent, I think. I don't think that they have the ability
I heard they were impudent.
I don't think they have the ability to forestall this. I think by flooding the system with more liquidity, all it does is create inflation, and then they've got a different problem to try and solve. And so, I think they're going to be late by definition because the metrics by which they measure inflation and employment, their two mandates, are lagging indicators. And so I agree, they're always late. And there is always a recession. There have been 10 recessions since 1957, and the Fed's been there cutting rates every single time. They haven't been able to prevent it, and they won't be able to prevent this one.
I'm going to ask for short questions and short answers. Andy?
So just a super.
Annabelle, can you get another mic over here? I'm sorry.
So Jeffrey, so everybody's focused on the Fed funds rate. Fed balance sheet's gone from 9 trillion to 7 trillion, and they're not buying bonds. But what they did do was buy 10 years and force it down to 1.32. So when I say cut rates and the Fed, is really going to react, they could go out and start buying bonds. Would that make a difference?
Well, yeah, they've done that before, and it would bring rates down, right? They would, but the bond market's way bigger than the Fed. The Fed can't carry. I mean, they could conceivably run their balance sheet up to infinity, right? But it's just going to destroy the currency. So, I think you got to look at the implications of the Fed growing their balance sheet and what it means for the U.S. dollar.
Fantastic, great. Goodwin, you have a question?
Given the conversation about stable.
Did we lose the?
Stable.
It's got to be green. We have another microphone coming.
Given the conversation about stable coins and Ethereum and Solana and the like being critical in that adoption and the Trump backing of crypto, where are you putting crypto in your thinking here?
Well, it's a great alternative asset. It's a non-dollar asset. Therefore, I think it's a monetary inflation hedge. We've had $142,000 target on Bitcoin. We're published there. But honestly, I've been doing a lot of research on something called the flippening. And the flippening basically is a theory that suggests that Ethereum will usurp Bitcoin as the top cryptocurrency. And the reason that would happen is the entire crypto backbone is built on the Ethereum network. And even though Ethereum isn't limited to 21 million tokens, there's an infinite number of tokens because it's supporting the backbone. Those tokens get burned off by its utilization, and so they're constantly issuing more tokens. But those tokens are also dissipating with network use, and so it's a control feature that's built right into it. I think that the market cap of Bitcoin is something like 5x Ethereum right now. I think Ethereum could usurp Bitcoin's market cap, and Bitcoin's market cap's likely to continue to go higher. And so I think the real play is Ethereum. And, the easy way to play it is to just buy the ETF, which tracks it,
Do not tell me you told me so.
in lockstep,
Couldn't agree more. Thank you.
What about Solana?
I haven't done any work on it, so I don't really have any comments.
So any other questions from the audience? I have other questions.
So why do you think the dollar is going to continue to weaken?
Well, number of reasons. I think there's a ton of issuance, Treasury issuance. So, something in the neighborhood of $2 trillion, maybe another trillion if Trump has to refund all of these tariffs that he's collected. That issuance is going to put a lot of pressure on the long end of the curve. And I think rates could back up. I think that if rates do back up, then I think you're going to start to see people question, the U.S. currency. I also think that there is, the SCO last week in China, concluded with, the notion that China was going to begin to fund a new intermediary to take the place of the World Bank and the World Asia Bank. And so, I think all of these emerging economies are going to, basically create their own version of a World Bank they already have. And it's going to be largely backed by gold. And so all of these central banks have been accumulating gold aggressively in anticipation of that. And I think there's, basically a continued, transition away from holding U.S. Treasury debt as a reserve asset and a greater focus on holding gold as the primary reserve asset for, something like 60% of the population of the world. And so that is not going to be without consequences. And I think that will continue to put pressure. Now, the other thing is a lot of debt's being, rolled over at the short end of the curve. And if rates continue to go down on the short end of the curve, that actually takes a lot of pressure off of gold because, the opportunity cost of holding gold tends to become, less intense. And so, there's just less reason to want to hold dollars if you're not an American. Now, I agree, the U.S. hegemony, militarily, maritime, et cetera, until they start paying soldiers and sailors with gold bars, the U.S. dollar is going to continue to be a highly functioning currency because it really just isn't an alternative. But I think as a federal bank reserve asset, there's going to be a lot of pressure on the dollar.
I think that 80% of foreign corporate debt is held in dollars.
Yeah, it doesn't surprise me.
I think it really impacts this whole tariff thing. I think that tariffs are going to cause a huge recession internationally, which I think probably speaks badly for global corporations like Fortune 500 companies, which have large international operations, like a PepsiCo, for example.
Yeah, nobody's going to be immune to tariffs.
So what do you think about the collapse of France's government yesterday?
It's not the first time we've seen these sorts of issues occur. I think I'm not an expert on the subject, so I'll preface it by that. But I think they'll elect a new replacement government, and things will go on. It's the way it always happens. The same thing happened in Britain a couple years ago.
Interesting. And Israel attacked Qatar today?
That I did not know.
I think
but that doesn't surprise me
prices
either.
are spiking. So outside of the impact on oil, what do you think it's going to impact?
Well, look, I think that the geopolitical, landscape is extremely volatile and will continue to be so for the foreseeable future. I think, the interplay between China, Russia, Iran, North Korea as kind of this, de facto axis powers versus NATO, Israel, the West at large, is now being challenged by others. Brazil, most recently India, making friends with China again. Who would have thought? I think there's a real possibility that India and Pakistan could go head to head again here, and Israel will be in the middle of that as well. It would not surprise me to see Israel take, kind of evasive or pre-action to prevent or minimize some of these actions. So this attack on Qatar, is it a surprise? No. I mean, I think we've learned that Israel is going to be a preemptive actor militarily whenever they see a threat to their viability long term.
Annabelle, I have a need for a microphone. Just one last question for Andy. Another question. So I think that you made a presentation about a year and a half ago when we were over at Citgo, and you were very negative on the U.S. economy, but maybe there was a Fed intervention and different things happened. It didn't go south as you kind of predicted. Although, a lot of your predictions on buying gold and commodities and energy have been prescient, right? So how do you balance out the fact that sometimes, from my worldview, you're kind of right on macro, but the Fed intervenes. So, some of your predictions get delayed. Any thoughts on that?
Yeah, I don't have a time frame. I'm not predicting something to happen at a specific point in time. Okay. But I see that, all of the dominoes are starting to wobble here. And it's just a question of when, one is big enough and gets wobbly enough and falls over. We just haven't seen that yet. But, I would tell you that, the table's shaking at this point, and it's just a matter of time before that occurs. I couldn't tell you exactly precisely when it's going to occur.
Perfect. Yeah. So I think that Scott Bessent, I think that he said 6 months ago, he said that they didn't want to make large cuts to government because it would cause a recession, right? So I think he kind of denoted that their policies will be inflationary and just hedged by tariffs. I don't think that the tariffs will be rejected. I think that they'll go to the Supreme Court and it'll be upheld. And again, as I said, there's going to be a recession for the rest of the world. It's going to be bad, but in terms of the United States, it will benefit from the tariffs.
Yeah, it will benefit from the tariffs in one respect. Okay, if the funds that are collected are used to pay down the national debt or fund the deficit temporarily, then that'll take some pressure off of issuance. If they're not doing that, if it's just a further boondoggle, and that's all we've seen so far out of every administration, great intentions that never come to fruition because something always happens to require them to intervene. Look, people have been saying this for a long time. We're never going to have another recession, right? We are going to have another recession. I don't know when.
I think 90% of economists say that we're going to have a recession in the next 18 months, right? So
yeah, I don't know when. It might be sooner than later based on all the data that I'm seeing come in. What I do feel like, and we didn't really get into the internet bubble, or I'm sorry, the AI bubble, but there was a great analysis done, and I republished it in my newsletter by a guy named Harris Kupperman. And, he's a big cash flow guy, and I'm not a forensic accountant. I never claimed to be. I'm a macroeconomist, but he is. And so, he looked at this AI build out and the infrastructure build out and the data center build out, and he concluded that, these guys are going to have 40 billion a year in annual depreciation that they have to earn revenues against, right? And they've got to earn a return on capital, right? And that return on capital has got to be around, say, 20%, right? Or why would you take all the risk that you're taking? And you've got every single player doing the exact same thing. So this is likely not going to work for all of them.
I think the real issue is that, it goes back down to strategic forces, and that there is whether or not any of this AI will have pricing power, right?
Well, that's his point.
China's going to flood the market with cheap AI, right?
Yeah, they're giving it away right now. And the question is, how will they ever be able to generate the 480 billion a year in revenue annually in order to offset that depreciation expense of the data centers? and they can't. Okay, I mean, Microsoft Office 360, okay, is 95 billion a year, and everybody has adopted that. So not everybody's adopted AI, and not everybody's willing to pay for it, especially when so many people are giving it away for free. Now, just like Global Crossing, just like Level 3, just like WorldCom, all these places, they built out all this dark fiber, and it's being used. What they didn't count on was that that fiber would generate revenue, and it never really has. They've never been able to get the price for it, even 25 years later. And so I'm dubious about whether or not all of this CapEx will generate a return on investment. And if it doesn't,
it's really interesting how it's all going to play out. I'm not sure either. So, but we've got one last question, and Andy told me it's going to be very short.
Actually, it's super short comment because we had it backwards on Qatar. America has U.S. base in Qatar. Iranians had attacked the U.S. base in Qatar. Hamas in Qatar is a Iranian proxy that the Israelis attacked. They did not attack Qatar. It's a general effort amongst the Middle East to get Iran and its proxies out of everybody's business. So it's not an attack on Qatar.
It's just bombs that blew up in Qatar.
It's the Israelis trying to degrade the Iranian presence. And
I saw that it was targeting
Iran,
Hamas.
yes, and Iran had already attacked the U.S. base in Qatar.
It's all, it's intriguing because there's also a separatist movement in Canada. So there's these Sikhs who live in Canada.
That's 50 years old.
Right. And they've been trying to separate in India for a long time to have their own homeland. And there was an assassination team that was sent from India and killed 5 of these guys or something like that. These separatist leaders. And there was
Qatar's an American ally. Qatar's still an American ally. The Israelis didn't change that.
Oil prices are spiking. It wasn't any other comments? One last, yeah. Do we have the microphone on?
Just to add on that excellent point about the attack at Qatar, I think you should just reflect on the language and use the language you like. But I would, in my view, it's not an attack on Qatar. It's an attack in Qatar. That was a precision strike aimed at the Hamas leadership. And it depends, I guess, on your view if you feel terrorists, individuals who are recognized by many countries of the world as a terrorist organization, deserve sanctuary everywhere in the world that they travel.
It's purely an economic discussion. What's going to be the economic impact of it happening? That's all. In Qatar. Okay. I agree. So anyway, Jeff, any closing remarks?
Well, I'll give you guys a heads up. My top actionable trade idea for 2026, I'm going to tell it to you right now. It's the healthcare industry. Healthcare industry is trading at a 30-year relative low and a huge discount to the S&P 500 and growth peers in general. That discount's about 33% discount. I think that healthcare stocks have been left for dead. They've been ignored because of AI, but this is still a growth sector, but it's also recession resistant. And so I think you've got, an opportunity here to buy a really, really cheap sector and plant some seeds for, harvest sometime in 2026, probably in the 3rd or 4th quarter of 2026. It'll be a great trade.
That's intriguing. Yeah, absolutely. I think a lot of healthcare people will be happy to hear that. Fantastic. So, Jeff, my only question is, can you please take down your presentation so we can all see the regular screen and go from there? And thanks so much, Jeff. Great job.
Yeah. Okay, will do.